Hi, this is Ron Janish with andrewscourse.com, and this video is about when to buy or sell using Andrews median lines. Well, one of the things that we look for in Andrews median lines is we look for reasons why the market is going to go in a given direction. And we can do that and make those measurements using market geometry. And uh, typically there are several things that you would look for, and you can, if you need to have more detail on that, or a refresher if you're a course member, just go through the course manual. The last two chapters are absolutely ideal for that. um, anyway, this is an example of what happened last night. Now, when the market was up over here, I received a phone call from a course member, and since I give out my phone number to course members who every once in a while give me a call, they know I don't give recommendations, but I'll answer questions straight out. And the question straight out that I was asked after the market had shot up here last night was, "Are you still short?" And I went, "Yeah." And so anyway, here I am sitting on the short side, and let's take a look at why I was so comfortable with that. Well, the reason that I was comfortable with that, there was a number of things, but in terms of the intraday pattern, was that prices had zoomed through the ML. So they even did a power zoom by going past the far parallel, and they retraced back. And the theory is, in most cases, they will go further in the original direction. Now, I personally, I like the zoom theory. Okay, I'm the one who came up with the zoom term. I wrote about it a very long time ago, Stocks and Commodities magazine. And I like zoom theory. Um, the the thing is that what I personally do, and I teach in the course, is what other things to look at to make this a very high probability situation. Okay, and so had you drawn your median line from low, high, low, you would have seen that prices almost made it back up to it. Okay, apparently there were a lot of sellers up here because they left a space. Didn't quite get there. Just a little bit of a space. So anyway, but if you're a course member, you would have drawn your lines and you would have seen that there was other very good course lines to use for your sell up here. In the last chapter of the manual, in the second to last chapter of the manual, you would have had this here as a just absolutely picture perfect um, low risk entry situation. But so much for that. That's all could have, would have, should have. And that was in the middle of the night last night when everybody was sleeping, pretty much. So, but let's take a look at what else people would use. Now, and what Andrews taught. Now, Andrews taught that if you're using a daily chart, after you find your course reasons why there's a high probability that prices are going to reverse, you use something called the mini median line. The mini median line simply uses closes, high, low, high, close, and draws the lines from the close. And after prices go through the H, boom, there's the textbook short signal. Uh, some people are rather daring, and they buy and sell whenever they can draw a mini median line. Personally, I don't do that. Anyway, what I do, and what successful course members will typically do, is they will look at a chart and examine it using the course concepts and the course rules, and the advanced course concepts and course rules. And they're a bit different from the rules that, actually they're very different from the rules that Andrews originally put out. We show you Andrews originally rules, and then you look at ours, and they're a bit different. We're using Andrews concepts, but we're using them the way he taught me at the private and others at the private seminars, and what I learned at the kitchen table with him. Okay. So what happens is sometimes I will buy or sell at the ML. Okay. Here was a situation recently, last day or so, where I sold at the median line. Prices went up to the median line, and I went short up here. Okay, and it just coincidentally happened to be an intersection of an MLH and an ML. and a median line. Prices were going back up to it. Now, why would I do that? Because after all, this is a nice strong uptrend. Looks like prices are going up for a while, right? Well, truth be told, as Andrews taught it, he said, well, look, to put it in the simplest form possible, is prices will go in a given direction and the strength of the trend will vary. But they will go in a given direction, according to Newton's laws of motion, for a while until there is something occurs that makes them go the other way. Right? And what happens in the market is that there's buying and selling, and we try to measure this of what's going on, of this change going on with different indicators. And with Andrews, you have a few specific geometric rules and indicators that you use in order to determine that the momentum is now shifting from going up to going down, or that there is a high probability that this is going on anyway. And so what happens is over here, our rating for downside was 8. And so with that kind of a rating, um, I'm looking to sell if prices go to the ML or other places which give me a fairly tight risk entry. And boom, there we go. Now, let me just quickly jump to a different one. Does this ever fail? And what happens when it does? Not a problem. Take over here. We had this arrow. Okay, we had this arrow. We were looking at silver, for example, to go down to about 20 bucks. Now, over here, we had an R7 buy, but over here, the sell really wasn't very strong. And normally when you get an R7, you typically have an up move that lasts for a month or two. Okay, so what happened was it just was just looking very, very weak. Nothing was going on. And so he said, well, there's a good chance it's going to go down to 20 bucks. And then what happens is prices came down here and came back up in this area here. And at that point, we had a double signal here. If course members examine this here, you'd see that there's a double signal. And to the buy side, that this was going to continue. And like crazy, up she went. And that happens. And so there was a small loss taken on the short side. And up she went. So when you have that double signal, you really need to watch it. Let's go back to what we were looking at. Okay, so here we were talking about selling at the ML. Here's a nice example of the S&P. Now, those of you that remember my S&P calls along the way here, yeah, on this day here, I mentioned that this was May 1, that the Dow had made a top and down we go for a while, and when we hit down here, it was, gee, this made a bottom and up we go for a while because of the signal called an ORE. Truth be told, we also had several other things that came in here using Andrews' form of analysis, and so this gave us a rating of 7, and this gave us a rating of 4. And then as prices came back down here, said, oh wow, this is really cool. Away we go. And so here we had an R7, and then once again after an R7, prices typically go the other way for a good long period of time. Now, if you just look at this R is reversal rating. If you just look at this here for a second, if a 7 is very strong, okay, you go from a 7, and then a 4 will chip away a little bit. And as prices come back up against the trend, there will be a reversal, but it will be or even with the trend sometimes, there'll be reversals, and there'll be R1s or R2s. Just you'll have a reversal, but it won't be a real strong one necessarily. For example, here prices came up and you had a reversal, but this one was only rated R1, and so and when you get an R1, so then then you only come down a bit for a few days. Okay, here another one, another one, another one, and so what happens is you use your other course indicators to know when to get in after these small R1 corrections. Okay, and so how this is relevant here is that when I look at something like this here, this might be this reversal here. I might not have rated this on the daily at all. Okay, this downside move, probably have this as a 0 using daily bars, and this came back up here again. I have this rated right now as an R8. So, and since then it's come down a bit. So this is how it works. Let's move on. So like I said, when you have something that has a minor R rating, you really want to look at when and you're in a good strong trend to the upside, you want to look at prices when they come and test the prior extremes. They'll usually hit the median line or come very close to it and give you another opportunity until the trend changes. Okay. Let's take a look what we have next. See, here we have, for example, another situation. This we bought this morning. This is a stock we bought this morning, and this has an R8 rating, and that means there's a good variety of things in the course methods that tell you this has a high probability of going to the upside. And so when prices came down to the ML down here, we were in there buying, okay, because these highs did not have any kind of a significant reversal rating. Okay. Let's take a look at some examples of stocks we can look at with trades that we can look, actual trades we can look at with perfect 20/20 hindsight that were documented. Okay, and this was one. This was Maxwell Technology, and you can see here we have this zoom, retrace back, and further in the original direction. It's the concept that the public knows, and if anybody who's taken the course can look at this price at this point here and see what I used in order to rate it very nicely as a good strong up move. And so we wound up buying over here, and then we wound up getting out over here, and we posted this to the Precision Trader group, the Yahoo group, and then we also put it on the web. And what we did was when prices went up here, we got out and bought this one here, and we took the funds and bought this one here, and notice that prices went down to the ML, and since this one was rated R7, we know this one's got a good strong move ahead of it. Now sometimes when you get a 7, you'll get an immediate crazy pop, and that just happens, and that's what happened here. And so we're very fortunate in that situation, of course, but sometimes you get an immediate crazy pop. And if you're looking for a strong move from an R7, here you got a nice pop to the downside. Okay, this one took a little longer on a percentage basis than this one here, but if you get a incredibly high percentage move on one that's rated very, very high using Andrews, you probably want to really quickly look at your course indicators, because you might have something in here that will give you a 4 or 5. And when you get that at a high up around here, let's say, for example, you know that it's got a good probability of at least going sideways for a while. and a while can be a month or so. And we've all seen stocks that have made an incredible pop to the upside and then just go sideways and sideways and sideways and sideways and so um, anyway, this, I hope this gives you an idea as to when to buy and sell using the median line. For more information on the course techniques and how we do things, and the course manual, and the 25 videos, and the private discussion group, and the free live seminars where you can come to, okay, join the andrewscourse.com. Okay, andrewscourse.com. Come on over, and love to see you. Anyway, till next time, bye.